So you need money for your business. Let's talk about that. This is a topic I hear all the time from business owners who are struggling, entrepreneurs who have a business idea, business owners who aren't necessarily struggling but want to grow and they need cash and they're growing broke, right? For those of you who watched this channel before, you know the phenomenon of growing broke where you're not protecting your profit margins, your profit margin percentage. You're not protecting your ability for your business to efficiently produce cash. That's a big deal, right? So if you're not familiar with that, actually head over to. Let me share this right quick. Let me take this down because you don't care about that. This class, it's free. I'm going to put a link in the description. You can go over there to the Business Owners Money and Finance course. It is 100% free, and it will it'll open your eyes to certain things around finances and bookkeeping and accounting. But it's not like trying to make you into an accountant. I've noticed that there's lots of courses out there, and I check a lot of people's stuff out, not to criticize it or anything, but to learn from it, right? And one of the things that I see in the accounting space or the accounting and bookkeeping space is not designed for business owners because you don't need to know like all the intricacies of a chart of accounts. You don't need to know all the intricacies of a you need to know what a balance sheet is. You need to know what an income statement or P&L is. You need to know those things. You need to know statement of cash flows, right? But you don't really need to know like the intricacies of a general ledger, right? Like you don't need to know debits and credits. Like that's all bookkeeping and accounting stuff. Like that's how you make the sausage. I just need to know that the sausage is delicious at the end of the day. So, and I certainly don't want to watch it being made. Right. So if you're interested, head over to that link. It's 100% free. So the concept of growing broke, right, is if you're not protecting your profit margins, and that's a big deal. So what I hear a lot of times is like people are, they're growing, but they need cash to do that. So because they need cash, they think that, well, I'll just take this amazing idea that I have and I'm going to take it over to a bank and they're just going to loan me all sorts of money. And that is possible, maybe, but generally it is usually not received with like this open arms, like, oh my gosh, where have you been my whole life? I can't wait to give you piles of money. So there are ways to go about this, and generally banks are not your friends when it comes to stuff like this. I mean, it's going to depend, especially if you've got a new business idea. They're not going to be open to that. They're generally not going to be angel investors unless you're going to come to the table with a substantial amount of your own money or a substantial amount of collateral. And usually they're going to want personal guarantees. Usually they're going to want collateral like your house, your cars. They will file a UCC1 in the United States. They'll file a UCC1, which will attach to basically all of the other assets, or it'll specify generally in the UCC1, but it can attach to accounts receivable. It can attach to inventory. It can attach to raw materials, all these different things. So, if you're a roofer, for example, and you've got pallets of shingles laying around, that might be worth $30,000-$40,000, they can attach to that. Generally, they're not going to give you the full value of it as collateral. They'll usually discount it pretty heavily. You discount it 60-70%. In case they did have to seize it back, then they have to go actually, and they have to take it, they have to secure it, they have to find a buyer for it. So there's a lot of discounting that they'll do with that type of collateral. But that's the sort of stuff that I'm talking about, that as terms of why a bank may not be your best source of funding for a business idea. If you've got an established business and you're thinking about that, then you'd say, okay, well, um, generally you should work with someone who understands it. That's actually, I have a background in that. I was an underwriter for a while, specifically a commercial underwriter for commercial loans. And I did that for a long time. And so I speak banker, like I know what they're looking for. I know that I know for them, they're worried about their risk rating, because banks are really in the business. Yes, they're in the business of loaning money, but they're primary concern is to manage risk. They don't want to take on a loan that's going to go bad and make them look stupid. So because they've got to answer to bank examiners, they've got to answer to not only the state um, uh, banking authority. Many states are called DFI, Department of Financial Institutions, but they go by various names. But they've also got to answer to the feds, right? I believe I'm pretty sure it's still around, the OTS, the Office of Thrift Supervision. But either that or the federal government, they've got to answer to those governing authorities, because the government is providing a guarantee for their deposits. So if they're taking on deposits that they're going to loan out, they're going to say, cool, if you're going to be federally, FDIC insured, then we need to come in and take a look at your books and make sure that you're lending in a sound fashion, right? And there's generally accepted banking principles that they will allow and that they want to see. So for you to come in and say, hey, I've got this banking idea, or I've got this business idea, hey, would you bank on me? It's going to depend. And generally it's going to usually be very cash flow dependent and very collateral heavy. So those are two main things. If you don't have collateral and you don't have cash flow, then a bank is probably not going to be your best option. They're just going to say no. It's going to be a massive waste of time. And I don't want you getting discouraged. So for something like that, you'd be looking for more like an angel investor, or someone to come in or even someone who does have collateral and cash flow and can co-sign for you or act as a guarantor. So that's that. But let's say that you're in business, right? And I could do a whole series of videos on angel investing. That's beyond the scope of this particular call. But if you've got an established business now and you're in need of cash, some of the probably worst ways to get money is relying on a credit card. Now, why is that? Yes, credit cards are really handy, and we use them. I've used them in all of the businesses that I have, and I specifically, since they started coming out with these rewards, because you can use the rewards, like for, one of the things that I always suggest is use your rewards to buy a physical asset, right? So let's say, there was a company that I was working with that was, I was their strategist for a while, and they were running probably close to 100 grand a month through their credit cards. And I mean, they churned it over quite a bit. So what would happen is they get all these reward points, right? So if it was 2% cash back, they're getting like 2 grand back a month. Well, the unfortunate thing is they didn't recognize the value of actually taking those points and buying a physical asset with them. They were using it to pay down their balance. Well, here's the problem. When you use it to pay down a balance, you get one basically reduction of your expenses. Okay, big deal. So if you had a $100,000 bill, now it's 98,000. But the difference here is that it's free money. It's like legit free. And the interesting thing, and I hate to say this even publicly, and I'm just interested that why Congress hasn't figured out to tax that yet. Right? Like, why aren't they requiring a tax form at the end of the year? But I shouldn't even put that out there. They already have enough ways to tax the small business owner. But for example, if you were to take those points and use those points to buy, say, silver or gold, now you have a hedge. Now you have a physical asset. And if you had been doing this over the course of the last, 3-4 years, you would have seen silver prices go from low 20s to right now it's over $38. So it more than doubled in price. So you would have had an asset if you been buying at $2,000 swaths each month. That $24,000 worth of silver that you would have had in 1 year's time would now be worth almost 50,000. Pretty interesting. That's why. So that's why I say you should convert that to a physical asset that appreciates, right? Now, don't just go out and buy a stupid tchotchke things, but buy things that will appreciate in value as an appreciating asset. So just a little money hack that I like to use there. But in this particular case, going to a bank for certain things like let's say, for argument's sake, that you are running into a payday, like emergency payday thing where you're like, oh man, I'm like going to be running low. There are lenders out there. In fact, it's an entire, I don't even know how big the industry is. It's got to be easily a multi-billion-dollar industry that loan money directly to businesses. Specifically, they target small businesses. And they're really like, I hate that they're like payday loans, but for businesses. And the interest rates are ungodly high. And I was thinking, like, man, how is this not usury? Well, usury really doesn't apply in many states, doesn't apply business to business. It applies, it's consumer protection. It doesn't really apply to the businesses. Now, if I have that wrong, please put that in the comments, but I am pretty sure that is the case. So they charge whatever they charge, and they charge an ungodly amount of finance charges and interest and origination fees. I mean, you might end up paying, and here's the bigger problem. It's not even the interest that's the problem, although it is a problem. I don't want to minimize that. It's the loan constant. The payment terms on those things are almost usually the longest that I have seen them in terms of their payment schedule is weekly, but usually they'll want anything from as short as daily to sometimes several times a day. They want payments, and that's a lot to ask of a business owner. So, if you let's say that you have payroll and you have a $60,000 shortfall and you borrowed, say, 200,000, you can expect to make payments sometimes weekly on that 200,000. And when you add up all the payments, and usually they want it all paid back within, the longest that I have seen, and I have shopped some of them just to kind of get some data on this, but the longest that I have seen is a year. They don't want to go beyond 12 months. Many of them like to be done within 6 months to 9 months. And there's all sorts of different, I mean, I don't even want to put any names out there because I'm positive by the time I put the name out there, it'll be under a different name. But you will not have any difficulty finding them. And once you get on their lists, oh my gosh, they are on you like a freaking Band-Aid. So these are the sorts of things that you have to be careful about. So, does in this particular case, I mean, you got to do what you got to do sometimes, but this is how businesses can really get into trouble when they start borrowing from these loan sharks, and they will attach UCC ones. And sometimes getting those things released can be a gigantic pain in the neck if they're not responding, or I mean, it's a real pain. So you got to be really, really careful about who you hitch your wagon to in terms of your financing, because it can absolutely wreck an otherwise good business. So this is why it's really a good idea to be really financially literate, have really, really good financials, have very strong balance sheet, have very strong income statement, and know what you're looking at. So that way, if you are bankable, and you can, most businesses that have been in operation for a little while generally are bankable. But if you've been in business for a while and you got some cash flow coming in, and you're growing steadily and you're showing some good returns, it's really important for you to understand what debt service coverage is and how to calculate that versus debt to income. Debt to income is more of a consumer measure of debt versus debt service coverage ratio, DCSR. And a lot of times people will call them DSCR, debt service coverage ratio, DSCR loans. But really in the space, we always called them commercial loans, but they're calling them DSCR loans now. So that's something that I would recommend. Just get really familiar with what that is. That's stuff that I work with my clients with all the time. But check out the free course, like I mentioned, and it doesn't go into that, but the paid version does. But the free money, business owners money and finance course, that will give you a lot of the things that you're looking for. So that's all I have. Everybody, you have a great rest of your day. See you guys next time.